So a lot of pain at the broader end of the spectrum. One of the stocks on which there was some bit of pain is Symphony. So consolidated numbers came out, revenues up about 9.6%, but net profit down 43%, margins contracting yet again. Raw material costs have gone up. The question mark only is whether these are net comparable or no. Having said that, even if they're not comparable, the fact remains that there is pressure on the operational front. Let's try and figure out for how long would this last. Nupesh Shah, the Executive Director of Symphony, joins us right now on the phone line to talk about these numbers. Nupesh, good having you. Thanks so much for joining in. This is in line with what you guys had probably said at the end of Q1, that in the con call, that you don't know for how long the pain could continue because there was inventory in the system which may last. And even though you might be able to clear up your inventory, the prices may not go up. Tell us what's weighed in on the operational performance in this quarter.
So I would like to share in two parts. One is a standalone performance and second is the consolidated performance. On a standalone basis, our sales on Q2Q basis, that is in September it was 147 crore, while for December it is 159 crore. While for September quarter, the PAT on standalone basis was close to 34, now it stands at about 43 crore. So as we had indicated at the end of September, our first and foremost target and objective was to register Q2Q growth. Of course, on account of bad summer and also inventory pile-up in trade, YOY we were expecting degrowth. So I would say that performance is in line with our expectation. But for sure, until good summer sets in, we expect this negative impact to spill over till then. As far as our market share is concerned, despite so many new entrants have been there, at least in these 6 months and also in current quarter, it would be easily in excess of 90%. And now coming to consolidated performance, it is up top line wise from 219 to 240 crore, while at PAT level it is at 37 crore. But strictly speaking, it's not comparable because December 18 quarter is inclusive of Climate Technology Australia, which was not the case earlier. But all three overseas subsidiaries are performing in line with our expectation, and many more initiatives have been taken to improve the performance of Climate Technology in medium term.
Okay. Nupesh, I just wanted one small sense before we get to the consolidated performance as well. I think last quarter or the quarter before last quarter actually you had spoken about some exposure to IL&FS as well. Has there been any impact of exposure to debt paper of any sketchy accounts which would have impacted numbers this time around as well?
Fortunately, out of our entire treasury, the only exposure is to IL&FS. That too, it was about 21 crore, out of which we have already written off close to 25% in September quarter. Other than that, neither in any of the mutual funds, in none other treasury, we have any direct, indirect impact.
What would, good afternoon to you, Rupesh. Just want to know what would those steps be? You highlighted, you alluded to taking a few steps to make sure that subsidiary performances stand up in line with what you're expecting over the next few quarters in terms of growth performances. What would those steps or measures be?
Sure. So as far as GSK China is concerned, for the first time post-acquisition, for 12 months, which is their accounting year, at EBITDA level now it is positive. So if you recollect, when we acquired, the losses were about 12 to 13 crore, and current year it has almost broken even. That's number one. Number two, in terms of the top line for their accounting year, the top line growth has been close to 20%. As far as IMCO Mexico is concerned, current year has been performance-wise by and large in line with last year. And down the line, in terms of introduction of some of the new models, in terms of rationalization of some of the costs, we have initiated certain measures which we expect to yield the result in a year or two. But we do have very ambitious top-line growth expectation from IMCO Mexico on account of variety of reasons. There, in fact, we are now targeting market share rather than profitability margin. But having said that, overall kitty of the profit will increase. And as far as climate technology is concerned, I think integration process is exactly on track. Not only that, some of the A-grade items have been identified in terms of improving their performance, and that should yield a result in next, mostly medium term.
Your input cost also this quarter seems to have, shot up quite significantly. I believe closer to 5 times higher. What's the outlook there? Are you seeing pressures continuing?
As far as input cost or variable cost is concerned, on a standalone basis, there is not any material difference. But on a consolidated basis, there is a difference, obviously because overseas subsidiary companies don't have robust contribution or gross profit margin as we enjoy in Symphony India. So only that is an impact.
So how would that pie shape up until the base quarter numbers get compared apple to apples? You would reckon that on a consolidated basis, the margin profile will continue to look weak, Nupesh?
See, I think only in the accounting year 1920, post 1st July, it will be orange to orange comparison. You will appreciate that Climate Technology Australia we acquired from 1st July 2018. So only post that it will be comparable. So I think the better picture is to review and look at standalone performance. And on a standalone performance, our gross profit margin stands at about 48% vis-a-vis 50% last year.
Yeah, but I mean, the point is at some point of time, people will give multiples based on your console numbers, and which is why I was just wondering, would 18 to 20% be the new normal for the consolidated books of Symphony, Nupesh, going ahead?
Margins? Year as a whole, it should be higher.
You would reckon higher than 23, 24%?
Year as a whole, yes.
Okay. And lastly, even the return ratios, simply because your Indian operations enjoy such high return ratios, but I'm sure Australia doesn't. What is the target return on capital employed that you have? Not just for the next quarter. I'm saying for FY20 as a year, when the entire books will be consolidated, what's the target return on capital that you envisage?
No, we don't have any target about return on capital employed. Otherwise, also say on standalone basis in India, for current year, 6 months or 9 months, our weighted average capital employed was close to 80 crore. And as far as overseas operations are concerned, it is not in excess of 100 crore. So all put together, it is 180 crore. What we are targeting, despite decent growth and absolute increase in profitability, by and large, our capital employed should be in line with this. And hence, ultimately, with the growth, it should translate into better return on capital employed. As you know, we are company who is absolutely focused on return on capital employed.
Which is why I'm asking, since you're focused on return on capital employed, would you have a sense of what the console ROC numbers could look like a year down the line, a year and a half down the line?
It should be better than what it is currently. But just to give you some idea about return on capital employed, for the current year on a consolidated basis in 9 months has been in excess of 80%.
Okay, you're saying it will remain 80% or better than 80%?
Yeah. I think we expect that down the line it should improve.
Okay. One last question, and that is if you have any plans for last question from my end, you have any plans for a share buyback? You've fair bit of money lying in cash reserves.
Yeah, no, so we have already declared earlier, and it is in public domain, that as a part of shareholder payout policy, it will be a combination of dividend and share buyback. So at appropriate time, board will consider share buyback.